Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So yesterday's daily recap, we talked about how a lot of times people describe the stock market as stairs up, elevator down. It's you grind higher, you melt up, and then especially in the modern market, you can grind up and then get huge moves to the downside. And with whatever you want to attribute it to, QE or earnings growth or whatever you want to say, this market is sort of the opposite. You sort of have a situation where all the pullbacks this year have been very muted, very methodical, and then next thing you know, we're at highs, and that's what we got this week. Monday, Tuesday, Wednesday, we declined. We talked about how it's very rare in 2013 to see a 3-day down move, but all in all, it was a very muted down move. We never even breached the 8-day moving average. All the losses on those days were pretty minimal. And then just in 2 days, yesterday we reclaimed almost all the losses from the week, and today we broke out to another new high. So just more impressive action from the 2013 market. You can take a look at the SPY to get a visual of it. And as Mark and I talked about this morning, nothing really to lead you to believe that anything is going to change right now. You have Janet Yellen coming in as the new Fed chairman. So back when Larry Summers was being mooted as the possible new Fed chairman, people were worried about whether policy is going to change and how that could affect stocks and everything like that. Janet Yellen appears to be sort of the status quo for the Fed, if not even more dovish than Ben Bernanke. So from a policy perspective, nothing really in the way of the market continuing higher through the end of the year. And then you have factors like the Santa Claus rally. You have the January effect, where there's all these different factors that could lead stocks to continue to rise through the holidays and into the new year. So obviously, nothing policy related getting in the way of the market. Earnings season is behind us, was generally positive. The jobs market is the only real hindrance to the market right now, but people don't really seem too concerned and focused on that. But in general, bullish is the name of the game right now. Resilient is the name of the game. So as most traders have been doing for most of this year, it's buy the dip, buy the dip. Moving on to some sector-specific analysis, the IWM's also made a new high. We can go and take a look at the chart of the IWM. IWM for a period had been lagging a little bit, which was a little bit of a, I wouldn't say cause for concern because it wasn't any extreme weakness, but the IWM, the small cap index, when the IWM is strong, it's a sign of healthy risk appetite. When the IWM is weak, it shows that people might be rotating a little bit into more defensive type stocks, which is not exactly the environment that traders love to see. But IWM repaired nicely, found support at its 50-day, went back to highs, and today made another new high. So good to see IWM back in the game with 2 really nice days of action there. And then this morning we talked about the biotechs. The biotechs this year have been one of the strongest sectors in the market. And the biotechs are the type of thing that technology and medical technology is accelerating. It's exponential, the growth of new medicines and all that type of stuff. And so the biotechs, when the market gets a little tired, that doesn't mean the biotechs necessarily are going to be tired as well. A broad bull market, yes, that is bullish for the biotechs, but you see companies innovating and coming out with new drugs that are getting FDA approvals and really driving this index higher. But you look at take a look at the IBB. As you can see, this morning the big gap up, you could attribute that to the big move up in BIIB, Biogen, which I'll show you in a second. But in general, yesterday we talked about how the IBB was setting up for a breakout. It actually did break out yesterday to new highs, just inched its head above that prior pivot. And then you couldn't really predict the huge gap up due to Biogen, but the technical pattern was there, and sometimes price action tells you something's happening, even if you don't know what's happening. So that's what we saw in IBB, the biotech ETF. And you look at BIIB, a big reason for that. Opened up about 10% this morning. I don't know what the final percentage gain was on BIIB, but they basically got clearance or protection in Europe for a new MS pill that they had developed. So a big move there. And look at this macro trend in BIIB. Obviously, these biotech stocks, when they start developing drugs that get approved and gain in popularity, they can absolutely take off. They're also risky at times if they have a drug that people are expecting to be a big thing for them and the drug doesn't get approved. There is gap risk to the downside and upside in biotech stocks, but if you can pick a winner, they can obviously be very fruitful for you. As you've seen, Biogen, just as in 2010, it was a $50 stock. Now coming up on near the $300 area. So that was helpful. And then there's other names in the biotech sector that had more calculated type moves that weren't the subject of news. And Celgene benefited from that just general positive news in the biotech space and was able to put in a nice breakout today. Opened below the prior pivot breakout area, and then accelerated through it. So a really nice move there, and a nice multi-week move here from Celgene. And then another one, actually somebody on Twitter pointed this out to me today, Gilead, really nice looking pattern, similar type situation as Celgene. Nice multi-week bounce after a decent pull in there. You zoom out a little bit on the weekly chart, you can see huge macro uptrend for this one as well. So a really positive action in the biotechs, and just a couple names to keep an eye on. Also the banks. The banks are a huge sort of X factor for the market right now, because the market recently had sort of been pushing higher, holding higher without much participation from the banks. At various points of this year, in the last few years, the banks have obviously bounced off their lows from the financial crisis, but they've sort of been lagging and sort of been off the radar of traders. But now that JP Morgan got their settlement sort of out of the way, which was a cloud of uncertainty over the group, I think that's sort of helped ignite this group a little bit, and I think this is a trend definitely to watch, and I think the banks will continue to play catch up and continue to play a leadership type role based on the technicals that we've seen lately. We'll take a look at the XLF, the financials ETF. As you can see, we're on the weekly chart here. I'll go to the daily first. Really nice action breaking above this prior pivot, and then acceleration in the last 2 days. Showed relative strength to the market earlier in the week, especially on Tuesday. The market was, I wouldn't say accelerating to the downside, but had not the best day in the world on Tuesday, while the XLF actually finished higher. So that was your first sign of relative strength. Also held the 8-day, and then yesterday, big acceleration to the upside, whereas the S&P was still below its high. And then today, some nice little continuation there. And in terms of a stock-specific look at the banks, Bank of America has been best in breed. Bank of America has had a really nice uptrend. At this point, psychologically, maybe people are a little bit, find it tough to get in Bank of America after this big multi-week move. If that's the case, you look at a name like Citigroup. We pointed out off the charts, we listed it. 2 really nice days of price action. It led the way today as well. So you got this prior downtrend. We'll zoom out a little bit just to get a better look at that. This prior downtrend line that it now has to contend with. That I'll just adjust this line to give you a better visual of it. And that's the level if you're looking for a pure breakout in Citigroup. We're right there knocking on the door right now. So a break above that downtrend line could definitely generate some more momentum for Citigroup. And another one that I really like, not one of the bigger names, it's more of a regional, southeastern bank, Suntrust, STI. You look at it on the daily chart, nice bounce over the last month, 2 months, and a nice upper level bull flag after this igniting move. And today you got a nice acceleration. This week it had been very quiet. Maybe yesterday you could say a little bit of relative weakness of the rest of the banks, but today a nice acceleration above this upper level bull flag type pattern, and is also in a key weekly resistance area. So this is one that could definitely get going that might not have been on your radar as much as some of the other bigger names. 3D printers also continue to bounce back. We talked earlier in the week, the real concerning sign earlier in the week wasn't that minor muted selling that we saw in the indices. It was some of the technical damage we were seeing in momentum stocks, and specifically in the 3D printers, is that you never like to see a hot sector take the size of a haircut that some of the stocks in the 3D printing group took early in the week. And we'll look at the leaders first, DDD, Triple D, based in Rock Hill, South Carolina. Triple D, big topping tail on, I guess that was Monday. That was our first signal that even though it didn't have a full red dog reversal and closed back below and engulfed the previous day, that's a big topping tail after a stock that's gone parabolic in a very speculative sector. So that was a major sign that these either need a rest or some sort of pullback. Obviously, pullback was the answer to that question, and a big sharp correction for Triple D. We'll zoom in a little bit to give you a better look. SSYS, similar situation. We're at big topping tail, pull in back to its 50-day moving average. Found some footing with a nice bounce back yesterday, but now is just sort of in no man's land, so these will be interesting to watch. ONVO, one that purports to be printing human tissue. They sort of combine the biotech and 3D printing sectors to create a hot name in the stock market, but the reality is this company is about a decade away from even clinical trials. So had a nice bounce back yesterday, but not one that I would be definitely long-term interested in. VJet can't seem to find a friend, though. This is one that we listed it off the charts out of this wedge pattern after its IPO. Obviously, really nice move there, more than exceeded our targets, it's safe to say. But then really sharp pull in after Citron came out with a bearish article sort of saying that VJet basically has sold 3 printers in the last calendar year or so. That accounts for all of its revenue, and People took all the information in that report pretty negatively, and it hasn't been able to really find a lot of interested dip buyers. So 3D printers are the type of sector that I don't like to invest in these type of sectors long term at all. I think they're so speculative. They could either be huge winners or they could be absolute lemons. And if you're going to be approaching these, I think you have to use a short term, either a swing trader approach or a very day trader type approach. Be very nimble, tight risk management. Don't hold them against you at all. If you can get a good entry and get a potential move off of that with some trailing stops in place, so be it. But this, leave it to the very skilled type traders. If that fits your profile, then that's great. Join us on the VTF. Join Mike and Steve in the Trade the Morning mentoring room and get some guidance there. But in general, these are ones that if you're a longer term macro type guy, I would steer clear of these. Too much risk, too speculative in my opinion. And in the high beta tech group, there's sort of mixed action there. We talk about that a lot, and the tech sector is obviously a very large subset of the market, but the names that are highly followed, that are big mainstream names like Netflix, Google, Facebook, Apple, all those names are sort of diverging right now. You don't really see a broad trend in all those types of names. And there's a few that look like they could continue to the upside. I'll go through a couple of those. Amazon is one. Amazon here. Amazon, big earnings gap up. Went down to test a little bit of the gap, but never filled it. Held the 21-day moving average. Came back up, and now is putting in another flag. Today looked like it might want to break out, but a Friday options pinning type stuff. It wasn't able to break out, but I think that could happen next week. Next week might be a little thin, maybe in the next few weeks. Google, another one. A little bit lethargic recently, but overall you could say this is really healthy digestion in an upper base after that big earnings gap up. It finally crossed that psychological $1,000 price point. Holding above the 8-day now. I think this one could definitely get going in the next few weeks into the end of the year. But then on the flip side, there's a few that are not looking so good, and one that we've listed on off the charts as a short. Generally in a bull market on off the charts, we're going to focus very heavily on long ideas. But every once in a while, if a setup presents itself to the short side, we're going to list it. We're going to have tight risk management in place for those ideas. But Facebook is the name I'm talking about. Facebook put in a head and shoulders pattern. Head and shoulders patterns are a little bit tricky because they've technical analysis has risen to popularity to the point that when a head and shoulders pattern does form on a very followed stock like Facebook, everyone's talking about it, and it can lead to some choppy type trading where squeezes happen at key technical areas. But what you had with Facebook is that it looked like it was going to break that head and shoulders, then squeezed up, I think squeezed a lot of people out of it, and then in one fell swoop had a big harsh down day back into the neckline. And then while the market was bouncing back the last 2 days and actually having very constructive action, Facebook looked like it could, as it retests that neckline, break down with a weak day today. That social media group seems to be tapped out a little bit. Twitter's IPO, they juiced it up prior to it opening for trading, and hasn't really provided any type of action from its IPO. Obviously, it opened higher, had that very volatile first day, and then it's sort of just been hanging around in the low 40s. Not really providing much of opportunity, like I said, in either direction. And then LinkedIn, another one that's looking a little bit iffy right here. It's hard to fault a stock that's come this far for chopping around a little bit at upper levels, but it's another one that looks a little bit tired. And the group has gotten so much attention, and it's been such a popular place for money to flow that I think people are just a little bit tired right now and looking to rotate into some other sectors, like the banks, like some small cap names, like the biotechs, all those types of names, I think, are looking a little bit better. And then Tesla is another example, another darling of momentum traders. Again, it's hard to fault it after going from $40 up to almost $200 over the course of 6 to 8 months. But really harsh correction here we've seen over the last few months. And you go back to the daily chart on this one, also looks like it could be developing a little bit of a bear flag. You obviously have the issues with the fires and the Tesla cars. I think all that's overblown. I just think when a stock is priced for perfection, any type of negative news that comes out on it is going to lead to some downside and going to lead to some profit taking. And I think this was definitely a very crowded trade, a very one-sided trade. And while it was squeezing people over and over and over again as it broke out, I think people are a little bit less interested right now, and this one looks like it could be headed lower as well. And then one final name I'll talk about from off the charts, just to update a name that we've been mentioning on there. We listed Colgate on Wednesday, I believe, on off the charts, sort of a slower moving type name, something a little bit different than a lot of the momentum names that we talk about in the virtual trading floor and also on off the charts. A lower beta type name, gives a nice dividend, but Colgate, you can follow technical patterns on these type of stocks too. It's not, technical analysis doesn't just apply to momentum stocks, even though traders do gravitate there a little bit more often. But Colgate, we listed that $66 price as the breakout area, and today we finally got the break above it. 66.26 is where it closed, and this is one that I think could have more upside. Obviously, you see a big uptrend in these defensive type names in that low interest rate environment that's been in place since the financial crisis, but no reason to think this trend won't continue. And really nice igniting bar on the monthly last month, and then breaking above that prior high on the monthly chart this month. So impressive action there. Something from off the charts. Off the charts newsletter has been outstanding. We changed the format about a month and a half ago. People have loved it. We're more formally keeping track of all the ideas we present, following up with them, inserting trailing stops when appropriate, raising stops when appropriate on stocks that break out. So I think it's been a really great tool that not only has presented a lot of great ideas that have performed very well, but also educational to show people what we look for when we're game planning for stocks. Not all the patterns are the same. We identify what the pattern is we're looking for and all that type of stuff. But overall, I think it's been a very well-received product. It's $30 a month. If you're looking for more ideas, as we head into 2014, I think it's a great place to find them. But anyways, this has been John Darsie, your editor-in-chief here for the Daily Recap. We look forward to getting back at it next week. Could be a thin trading week. Thanksgiving, Hanukkah coming up. So, I think Monday and Tuesday we'll have all of our products out, all of our videos and stuff like that. And things will start to wind down towards the end of the week. But overall, constructive action in the market. And we look forward to continuing to bring you all the best ideas that we can find.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.